Hello, welcome to our Module 11 Financial Reporting. This is video 3, basically on preferred stock and some other little topics. I'm Jeff Mankin. I help you learn accounting and finance. All right, let's jump right into stock dividends. The previous video we did cash dividends, but here's stock dividends. So let's say that you have 50,000 shares of common stock outstanding. Remember, outstanding shares are what get to vote and what receive dividends. That represents the ownership. On June 1st, the board declares a 10% stock dividend to be issued on July 1st. The market value is $30 per share and the par value is $1 per share. So look at the very bottom here, 50,000 shares times 10%. That means that every person will receive 10% more shares, or 5,000 new shares that are issued. So if you have 100 shares, this 10% stock dividend would mean you would receive, after the transaction, a total of 10 more shares. You'd now have, instead of 100, you'd have 110 shares total. The market value is 30 and the par value is $1. So you've received 10 shares that are each worth $30. So that is attractive to you. So 5,000 shares times $30 selling price is a retained earnings debit of $150,000. So we say the total retained earnings, the total dividend is $150,000, and that's going to be into an account called dividend distributable. Now, for a cash dividend, it's dividend payable. For a stock dividend, we use an account called dividend distributable. We distribute stock, we pay cash. So this is a weird word that you haven't seen before, so we can abbreviate it. The next slide will show you how to abbreviate that. But that needs to be at par because that's going to show the common stock account in the second entry. So $5,000, and then the rest goes into APIC. So here is the first entry. I've cleaned up the distributable account, just made it DIST. And then the second entry on July 1st would be dividend distributable, 5,000, and common stock is at par, 5,000. So here are the two entries when you have a stock dividend. Now, this is a small stock dividend. There's such a thing as a large stock dividend. That's a different entry. This is only for 25% dividend or less, and that's the only one that we're going to show, a small stock dividend. So dividend distributable will eventually roll into common stock. Those two cancel out, and you can see how this works. Now let's think about a stock split. A stock split is anytime the company decides to take one share and make two. So that's a 2-for-1 stock split. Or one share and make 3 shares, or 1 share and make 4 shares. That would be a 4-for-1 stock split. So let's just use this Disney example. Let's say Disney has 40,000 shares of common stock outstanding. The board declares a 2-for-1 stock split. So every 1 share now becomes 2. So it effectively doubles the number of shares. The market value is 40 and the par is 10. Now, this is an easy entry to make because there is no entry. So no entry because nothing really happened. It just took the existing shares and doubled. So here is the things that you need to know how it works for a stock split. There's no required entry. No entry is the answer. The number of shares before is 40,000 times 2. It's now 80,000. So this could be, instead of old and new, this is pre-split, post-split. The stock price is 40 divided by 2. The new stock price will be 20. The par is $10 per share divided by 2. The new par is going to be $5 per share. Now, this is not really an economic event because the market cap, which is the stock price times the number of shares, is 40 times 40,000, so 1.6 million, 1,600,000. And after the transaction, it's 80,000 shares, but each are only worth $20, so it's 1.6 million again. So the reason why there's no entry is there's not an economic event. It just took the existing shares and split them in half. If it's 3-for-1, then it cuts them in thirds. So let's talk about preferred stock just for a minute. Similar to both common stock and bonds, preferred stock has characteristics of both common stock and bonds. So let's show what we mean by this. So here are the characteristics of a preferred stock certificate. It really is equity. It's issued as a stock. It's called preferred stock. So it really is equity, but it's not equity that has a right to vote. So there's no vote, so you don't really, it's not really tied to the earnings of the company. So it is different than stock. It looks a little bit more like a bond in this case. It has regular dividends like 5% or 6% or 7%. So these regular steady dividends look more like interest payments on a bond. So the bond, this preferred stock is not priced based on people's expectation of the stock going up. This bond is priced based on the percentage return that the dividends would pay. So it is like a bond that you never have to repay. Let's do an example, and this will make sense. Let's say Hotel Inc. has preferred stock of $100 par, and it's 7% preferred stock. So we take the par of 100 times 7%. So this bond is kind of guaranteeing a $7 per share dividend. So if you owned 100 shares, you're going to receive $7 times 100 shares, $700 for the year, each year, every year. So it looks like guaranteed payments that never have to be repaid, so it looks a lot like a stream of bond payments. Now this is paid before we pay any common stockholders, so this is why it's called preferred stock. So it is priced like a bond in terms of just a stream of payments, never-ending $7 payments. Now let's talk about the last little section here about the forms of business. There are really four. The first form is called a proprietorship or a sole proprietorship. So you just have one owner. It's very simple to start. There's no legal requirements. It has unlimited liability, and that's a real problem. So it's in red because it's a real negative thing about proprietorship. If you start a business, then it's really a proprietorship. If you decide to sell t-shirts, you have a proprietorship. If you want to do this for a living or for a part-time job, then you need to think about another form of business that has limited liability. The second one is a partnership, which is two or more owners. Once again, simple to start, no legal requirements, but it has also unlimited liability. That's a real problem. So a corporation has generally more than one owners, but sometimes I think some states allow just one owner. It is a separate legal entity. It has legal requirements to start. It has limited liability. The big disadvantage is the double taxation. You're taxed once at the corporate level. You're taxed again when you distribute dividends. The individual or the company that receives the dividend is taxed on the dividend. So the amount of dividends are subject to double taxation. That's a negative. The fourth category is kind of a new category in the last 20 years or so. It's a LLC is what I'm going to call it. You could call this a hybrid. There's other forms that are similar like LLP, but LLC stands for Limited Liability Company, not Limited Liability Corporation. It's not quite a corporation, but it's built to have characteristics of a partnership and a corporation. So it's taxed like a partnership, simple, flows through to the individual, and it has limited liability like a corporation. So that's important. Now, ultimately, what you have to determine is if you have a business, you have a new business, you have a part-time business, you have a something that you start, you need to decide really between the corporation form of business, corporate entity, or an LLC, which is limited liability company. Both would limit your liability to what you've invested. So to be a real business, you would really expect to see a corporation or an LLC. All right, thanks for watching our video. We'll see you on the next one.